The dollar is rising at a pace that we haven't seen in a very long time, but at a pace that we have seen multiple times in the past few decades. And the reality is this is causing major problems for the global economy. The rising dollar is putting a strain on the global economy in ways that last couple times we saw this happen, it caused major financial crises. And we are seeing seeds planted of the exact same thing happening again today. Ready? Let's dive in. It's no secret that the dollar has been rising as compared to the other currencies that it is measured against. This is a chart of the DXY, the dollar index, long-term chart here, and you can see three major bull markets in the dollar on this chart. We saw one in the 80s, we saw one in the 90s, and we are seeing one start yet again. Now, we've talked before on this channel about how a rising dollar means that dollar is more expensive to get for these countries, and so they have to print more or get more of their own currency to exchange it for dollars. And they have to do that because dollars are used in international trade. And so the strengthening dollar is causing inflation in many countries because they can't get enough dollars for the amount of currency they used to be able to get them for. So their stuff is getting more and more expensive that they have to import from overseas. But you might be asking yourself, hey, is this just poor planning, or is there actually something going on here where the dollar is taking up a place that it shouldn't be? And the answer is yes, the dollar is. Because the United States takes up, the GDP of the United States is about 14% of global GDP, but the dollar makes up about 40% of international trade. So the dollar has a much larger place in international trade than it should given the size of the economy that it comes from. However, that is all beside the point, because the real problem comes in when we start looking at debt. And you and I know that debt eventually must be repaid. And if it's not repaid in dollars that are worth the same purchasing power, it's going to be paid back in dollars that are worth less purchasing power, or it'll just be defaulted on. And so when you get an accumulation of debt to the point where, hey, there's no way for us to pay this back, then you come up with one of two alternatives. Either the debt is going to be outright defaulted on, or it's going to be nominally defaulted on through inflation, meaning they're going to give you back the dollars, but you're not going to be able to purchase as much stuff with those dollars as when you originally lent them. This is why debt is always temporarily inflationary, but it is long-term going to at least revert to the mean, and most of the time it will actually result in a wealth destruction when debt is created out of the fractional reserve banking system. This is because when debt is created, that money came into existence. Money is loaned into existence with debt. And so it's not like money is leaving your bank account going to somebody else. It's actually being loaned into existence. This means that many times there are virtually no limits on how much debt can be created until it's too late. And that's exactly what happened in the 80s. The Latin American debt crisis of the 1980s has been documented, and we're not going to go through the whole history because entire books have been written about this, but we can see here the timeline of what happened with their debt was absolutely astonishing. At the end of 1970, total outstanding debt was $29 billion in Latin America from U.S. commercial banks. But by the end of 78, just 8 years later, that number was $159 billion. And 4 years later, in 1982, that debt level reached $327 billion. Now, thought experiment about debt. If I borrow $100 from you, it pretty much doesn't even matter what the interest rate is. If push comes to shove, I'll be able to give you that $100 back. Even if the interest rate is 200%, I'll be able to pay that debt back and the interest. But there comes a point where if that debt gets too large, it's unpayable. If I owe you $20 million, it really doesn't matter what the interest rate is. I'm probably not going to be able to get the dollars to be able to pay you back the money that I owe you, right? And so once that debt load grows, the total amount of debt matters more than the interest rate. And that's exactly what happened here in Latin America in the 80s when the total amount of debt reached $327 billion. At this point, when that debt needs to start getting repaid, it has to get repaid in dollars. So the question is, where are they going to get the dollars from? And that is why you start to see the dollar do what it's doing right here, which is going up, because you have a massive spike in demand for dollars when suddenly they need to go out and get dollars somehow to repay all that debt. Now, as documented here on federalreservehistory.org, we can see that the major concern was the soundness and solvency of the financial system. And so the central bank, the United States Central Bank, the Federal Reserve, and the IMF both entered and organized a bailout and a restructuring in order to make sure that the financial system, the global financial system, didn't collapse as a result of the spike in the value of the dollar from this mad scramble to dollars from this massive debt that had accumulated in Latin America. So did they learn their lesson? Not even close. Fast forward just one more decade, you can see the dollar had another spike here in the 90s. What did that cause this time? The Asian financial crisis. In 97 and 98, a financial crisis started in Thailand, spread across East Asia, and resulted in a couple other things that I'm going to talk about after the debt part that spilled over actually into the American financial system, prompting the first internal Federal Reserve bailout in our own financial system. We see here again, documented on federalreservehistory.org, that heavy foreign borrowing at short maturities exposed corporations and banks to significant exchange rate and funding risks. These risks were masked by the peg, but a peg is just manipulation that is destined to fail at some point, and fail it did, again, sparking contagion and a global financial crisis. This ultimately led to the Russian crisis, where Russia defaulted on their debt. As we see here in November of 1998, the Russian Deputy Minister of Finance finally declared that their country would not be able to repay more than 10 billion in US dollars of its 17 billion foreign debt. Now you might be wondering, well, how in the world could that cause global contagion? This is just a few isolated little backwater countries. How in the world could this mean anything significant for the United States? Well, take a look at this book when you get a chance, called When Genius Failed by Roger Lowenstein, The Rise and Fall of Long-Term Capital Management. Long-term capital management was a hedge fund started by Nobel Prize-winning economists. So that should tell you something right there about the soundness of their strategies. But they were doing something called relative value trades. Basically, they would short something and then use the proceeds to buy something else. The two things in this pair were theoretically linked. They were supposed to go up together and down together. But they would enter the trade at a point where there was a little bit of a difference in the pricing. So they would be able to short something when it's a little bit higher, buy something with those proceeds when it's a little bit lower. They'd lock in, let's say, a $1 profit on that trade. And then they're going to go up and down together. So their losses and their gains are going to offset each other, but they're going to keep that $1. So you can't make a lot of money on $1. So what did they do? They used leverage. They used a lot of debt. So they went to banks, they got a lot of debt. And now instead of making $1 once, they make $1 millions of times doing the exact same trades. Well, the problem is these are all based on models saying, hey, these things are supposed to move together and will probably always move together. But what if your models are wrong? What if something happens that hasn't happened before in your data set? Well, that means that you could be at risk of blowup. And that's exactly what happened here. As we saw, the stronger dollar in the 90s led to the Asian financial crisis, which spilled over into this Russian debt default, which caused long-term capital management to be exposed to trades that were supposed to stay together, started diverging. Instead of the one that they shorted going down, which you would want to be profitable, it went up. And instead of the one that you bought going up to be profitable, it went down. That caused them to have such severe losses, they had to start unwinding the trades. But they were so intertwined with the American banks, the entire financial system here, that as they started to unwind these trades, massive trades because they used so much debt to enter these trades, it started to make the problem worse for everybody, because now you've got an entity with billions and billions of dollars selling something that's already falling, that's going to put downward pressure on it. And so you had this start to create a bigger problem just by trying to get out of these trades that they were losing so much money on. That's when the Federal Reserve stepped in and organized the very first bailout, set precedents. Do not underestimate the day of small beginnings, because the Federal Reserve started their habit of bailouts at long-term capital management. They didn't spend any money, they didn't print any money, they didn't do anything themselves, but they got Wall Street together and they said, hey, you guys need to get together and make sure that this thing doesn't take everybody down. And most of the banks in Wall Street said, okay, yes, we're going to do that. They bought out long-term capital management, shut it down, let it liquidate a little bit more peacefully, and Federal Reserve organized its first bailout. Now, fast forward from there to today, there have been many more bailouts. They took precedence, made a little bit of advancements each time, and now basically everything in the world hinges on monetary policy. It's all one trade now. It either goes inversely or positively correlated to what the Federal Reserve does with monetary policy. The fact of the matter is, everything that we saw in the Latin American crisis, the massive buildup of debt, everything that we saw in the Asian financial crisis, bleeding over into Russia, knocking over hedge funds, that all is being done today at a much larger scale. Every single financial institution in the world is levered up to make the Latin American crisis look like nothing. Every financial institution in the world has these relative value trades going on to make long-term capital management look like nothing. And at the same time, we are experiencing the dollar rising just like it did in the 90s and just like it did in the 80s. We have the most over-leveraged world we have ever had at a point when most debt in the world, whether it's China or America or Latin America or Europe, wherever you want to look, is denominated in dollars. So we are seeing a mad scramble for dollars as dollar debt gets more expensive so that they can pay off that dollar debt. That pushes the price of the dollar higher and higher and higher, and almost certainly will result in contagion in another crisis. But this time it's not just going to be Latin America. This time it's not just going to be some Asian country that bleeds over to Russia, a little hedge fund that can be bailed out by Wall Street. It's everybody. This dollar squeeze is hitting the entire world. And so this is what I talk about when I say contagion, when I say systemic risk, when I say something is going to happen from tightening and this rising dollar that will prompt central banks and the Federal Reserve to have to reverse course. I'm not talking about the stock market falling. That's going to keep on happening, and the Fed could care less that your brokerage account is down 50%, 60%, 80% from what it was a year ago. They could care. There's absolutely nothing that they will change as a result of your losses. But when the dollar strengthens to a point where it starts to knock over financial institutions all around the world because of these relative value trades that get blown up and losses on the balance sheets of banks that are larger than their entire market cap because they're so over leveraged, at that point, we will see contagion that will prompt central banks to reverse course. And at that point, then we have to worry about major inflation. But right now, we've got a lot of deflation and pain while we wait for this systemic collapse to come along. Hope that makes sense. Let me know if you have any questions in the comments section below. And as always, really appreciate you guys. Thank you so much for watching. Have a great day.